The only spot that had my attention from last night was this bullish order block. It's not the best retest, but order blocks are allowed to come into 50%. It's not a big deal because it's a much bigger range. So after having this low get put in, which we will go through, we just keep digging down to lower time frames. In terms of what else is on the 4 hour now, we have the 4 hour SIBI, we have buy side liquidity, which is the Monday high. And as I keep going down on time frames, I have more levels of 15-minute time frame. I keep the previous day low, previous day high, along with previous day equilibrium. Now we'll see why everything happened this morning, and we might have to start it off with talking about this little screwery that happened yesterday, just because this accumulation was very important for this move to happen today. Even though it was FOMC, we'll probably go through reasons of or how you could have taken entries and stuff like that. So let's start off with the morning time real quick. 9:30. Let me just mark that out. Uh, All right, 9:30 open right there. So before um okay, so what happened? Who just tagged? Okay, so before we go on for the day, right? We need to understand that what Asia and London did. Asia came up yesterday to take out PM highs. So PM highs got rated. After Asia was done with its objective, it pretty much dragged all the way down all London. By the time I woke up this morning, we had already started coming back into the 728 area, which was just teasing Asia highs. So the reason to understand what happened pre-market is because it gives you some sort of idea about market open. Asia highs was our last remaining liquidity as a target without looking for external. So this morning, as soon as Asia highs got rated, you can notice that we instantly started dumping right back down. Where did we dump back down to? New day opening gap. This morning, though, we had Trump speaking with Zelensky, so we were not 100% interested with it. I'm pretty sure nobody wanted to click too many buttons, and if anybody was actually at their screens at 9:30, you saw the volatility that came in. This little run up that happened, I think I blinked my eyes for like 2 minutes, and I already saw the price come right back to the high. But let's understand like why we came all the way down here. So, do you notice how we have a small little balanced price range over here? The one of the ways I use balanced price ranges is I want to see us getting out of the balanced price range. I don't care about the consolidation. I don't care about the move after. I usually just look for liquidity points, which at the time this morning was Asia highs. After the liquidity has been taken, leaving behind a balanced price range, I want to see a low liquidity run back into the balanced price range. Depending on if it still holds structure, we continue. It will eventually get bought up. It's another way to look at it as a Judas. It's the same concept as last night. We left behind all of this consolidation, which is exactly the reason why we ended up coming down after we did the run upwards. So let's see. At what time could we have actually taken a trade? So we already knew that Trump was going to be speaking on the mic at 10 o'clock. So at this time, we still were not confident if this move up was manipulation or not. So we just had to pretty much sit on our hands. But now, if you look at where this bottom came in right here, and you go on a 5 minute time frame, you'll notice that it actually just is a 2022 model, whereas where we did the displacement higher above Asia highs, and then it pulls back into the only 5 minute fair value gap that is available in the vicinity. This was it. This is the only spot where you could have taken entry unless you decided to be extremely impulsive and FOMO right off the open. Where did this deliver to? Do you see all of this on the left side? Where is right here? You see how, remember last yesterday morning, the first thing we did, we just started pressing down right off of open. This was the last swing high in this entire drop. So that's where buy side liquidity is sitting. So this is buy side right here. And what is going okay. Yeah, that's buy side right there. After reaching into this 5 minute bullish fair value gap, not only do we have this target, but we also have external targets that we can reach out for here. there is a better reasoning of why we came up there, and the 15-minute is why. Because when there's a buy side liquidity that's overlapped with the fair value gap, there's a very high chance that the market will also try to tap into the fair value gap as well. We know that the price is algorithmic. We also know that it's precise and it's accurate. So after this happened, this is pretty much where we got to take our exits. It's done. The objective has been fulfilled. We have been, and yeah, the objective has been fulfilled. If you guys are not aware, there are correlations between higher time frame gaps and market maker X models. Where so a 15-minute gap can lead to a 1-minute market maker X model, a 4-hour gap can lead to a 15-minute market maker X model, and a daily fair value gap can lead into a 30-minute market maker X model, or it could be 1 hour. I gotta brush up on that. So this after that 15-minute gap got hit, I should really clean up these charts. I'm sorry, I don't keep like this, but after the 15-minute gap got hit, I I actually took these shorts over here, mainly because I didn't. You gotta remember, it's FOMC today, right? They're not gonna want anybody to win from whoever's holding. And on top of that, lunch is also known to rate stops of anybody who's been comfortable from New York AM, which is everybody from this entire run up. So what does lunch end up doing? Let's take a look at this in a time aspect. 11:50. It's right here to 12:10. Right here. 12:10. For me, if the high gets put in on a macro, whether it doesn't matter for me if it's the opening or if it's like the last 5 minutes of a macro, if it both puts out the high and forces a market shift or structure, it's changing order flow to the opposing side, which is exactly why I was taking these shorts over here, and it's also overlapped with the 15-minute gap. After that, all you had to do was just track the remaining gaps that were being left behind. So after we got this market shift of structure right here, you can notice, why is this a shift of structure? This was the last swing low. Relative equal lows left behind after putting out a new high. So this is officially our market shift of structure. And to justify this swing high right here, if you go on the 5-minute, it's the 5-minute bearish fair value, along with the 5-minute order block. So it's a pretty good lineup. And only reason why this is trustable is because, again, lunch is known to do retracements on anybody who's comfortable from this morning. And along with the fact that we have FOMC, they're not going to want to let any of these guys sit through comfortably. So as you can see, this one moved out pretty quickly. It was pretty clean, not a big deal. So now, hold up, questions. Because I talk a lot, I talk very quick. Okay. This after the lunch macro was done, we have FOMC right over here. At the moment, we don't really know what FOMC is doing. We don't know if it's gonna go up. We don't know if the first candle is manipulation. We don't know if it's gonna Judas back down. We don't know anything yet, right? But only thing we do know is that right before FOMC came out, they left these relative equal lows, and the same candle that forces a break of structure, it also took out the swing low. So now we have a 2022 model in our hands. Why is it a 2022? Because we not only did a fake inducement over here and left relative equal lows, but we took out that swing and then we broke through it again. So I really do like it when the same candles that take out a swing low or the sell side internal, and then they do a break of structure, because it shows institutional order flow. It shows that the algorithm is on our side. It shows willingness that it's gonna come off with strength. So at this time, though, I will be honest, even then, I would not have tried going long off of this rebalance, because a lot of times we know that when FOMC is a two-step move. It's always two-step. We get the FOMC statement release at 2 o'clock, and then between 2 o'clock to 2:30, we will either do. I mean, look, I know today's like not a good example, but in most FOMCs, in my experience, we have always accumulated until Powell speaks. But today was slightly different because of the fact that we just been getting so pressed down for the last few days. It was a little bit easier for them to drag it up quicker. At what point was this tradable though? I'm gonna be honest. I mentioned this earlier in the chat. Try not to take a trade until 2:45, 2:30. You need to let Powell come on the mic so he can start. We can start getting a little bit better reactions. You could have taken entries off of any of these fair value gaps. Mainly because if the draw is still higher, it should work. But what I didn't like about this entry is that that rejection came off from this last bearish fair value gap. So at that time, I'm still a little like not confident on why. So the only time it was proper to take entries to go long for higher is after the high of the day got taken out. And on top of that, it also correlates with our time that we're looking to trade the market because we want all the accumulation, all the crappy action to be done so we don't get chopped up in it, we don't get stopped out in it. So notice how as soon as this high gets taken out, we have a fair value gap that's left behind, which is this one right here. Because we have played back and forth in this range already for a very long time, you want to see breakaway gaps happening. You really do because you want to see willingness to go higher. Like, how would you feel if we just kept constantly keep pulling back to the last fair value gap? At some point, the algorithm needs to start speeding up so it can start delivering higher. So the only place to take possible entries for this was actually this fair value gap right here, this IOFED that happened, along with the volume imbalance. And if I'm not wrong, I'm pretty sure this is a small little breaker that's right there. I don't trade breakers. I look at the market in terms of fair values. Um, if you ever play Tetris, you'll notice that like in Tetris, you have to fill in the gaps. Like you have to put the blocks in the tightest spaces. So that's pretty much how the market constantly kept moving upwards. So after this fair value gap got retested, you can notice that there's really good institutional sponsorship. There's good reactions coming off of it, creation of bullish order blocks, and they're not those bullish order blocks where we're playing around with them for a long time. The next candle instantly comes back to the wick of the order block and it just starts shooting up. We want to see that. We want to see willingness, especially because we took out the highs. We don't want to see it trying to come back down over here. We don't want that, especially if our draws are still higher. FOMC is a little bit it does feel like a gamble, but the draws of liquidities will always be the same. So like I said, I usually start off my day marking out previous day high, previous day low, and equilibrium. The fact that all last night we stayed away from previous day low, we've been pressing higher. The only spot that made sense for liquidity to be drawn to was previous day high today. So as you can see, that after this fair value gap gets retested, we just keep staircasing up pretty much. Fair value gap over here, break of structure. Okay, so that's that. Fair value gap. Nope, that's not one. Fair value gap right here, and it keeps pressing higher. Fair value gap right here, it keeps pressing higher. And as you can see, that's pretty much the constant pattern. One thing that I noticed about the market, and this is my own personal experiences, the market will pretty much tell you what it wants to respect. A lot of the times when the first few swings happen, right, especially before the breakout happens, it's going to tell you, is it respecting order blocks, is it respecting fair values, or is it respecting inversions? So the fact that all the way from 2 o'clock to this 233 point, which took out the high, has been respecting fair values, you can actually assume that it's going to continue respecting fair values. It's not going to pull back to order blocks. It's not going to try to do a random breaker for you, especially because it's in a rush to go higher. mm, Damn, what else is there? I think I just sped through that way too much.
No, I
um
think it's good.
But so about today though, right? We had way too much news events happening for us to gauge the market with full on confidence. Like I said, the only possible moves that you could have caught after FOMC was this one. And if not that one, the lunch retracement. And the only reason why the lunch retracement was possible is just because of the fact that we did not actually deliver to sell side. It needs to create new sell side. One thing to always remember, right, is that sell sides will always be overlapped with some sort of PD array. Okay, so that's how you get your precise numbers to do turtle soups. And second, if we want to run higher, it needs to take out sell side. Only time it will respect fair value gaps in between is if it's mid trend, meaning if the objective has not been hit yet, you can still buy in on fair values. But in this case, because we had already delivered above the AM highs, it was allowed to pull back. It's good. Like the objective has been delivered. Yeah. Okay. So now let's talk about this little reversal that came in, because I know everybody started pointing out SMT. We're gonna reverse things like that. One thing that I want to point out real quick, because I'm a huge I use SMT all the time, right? SMT does not always signal reversals. It could signal retracements. So now, let's pull up SMT chart right there. All right, so now when you put ES and NQ side by side, right? I'm gonna point something out. Let's note out the weekly highs real quick, which is on Nasdaq it's 20,165, and now if you look at ES, it's 5659. You will notice that ES took out the previous weekly highs, whereas Nasdaq did not take out the weekly highs. If you add YM to the mix now as well, you'll also notice YM took out the weekly highs, but Nasdaq did not. For SMT to be legitimate, only two indexes out of the three need to do it. So even if Nasdaq lagged behind, it doesn't matter. Two of the indexes still did it. Let's say in any one of these cases, if YM did not take it out and ES was the only one to take it out, then that is where Six Sister comes from. Because like I said, the rule for me has always been two indexes need to do it. So here we go. We're getting SMT now. I'll go back on NQ's chart. This was actually not that bad to try to short it over here. There's okay, let me see ES's chart real quick. ES took out previous day, previous week. Okay, damn, I can't really justify why we dropped down like that. I could have taken like entry wise, I get it, but I can't justify the aggressive drop. The only way I can justify like where we pulled down to from over here is that it's Asia highs. They pretty much just brought it back to the dealing range of the entire move. Mm. No, that's exactly what they did. Look, we're not here to try to catch every single move up. We want to catch the best plays, the ones that give us the best R&R. We want to be able to catch these longer trend moves instead of trying to catch every single zigzag. So in terms of the move up, the pullback, and then this move back up, I'm probably just gonna keep talking about the entries that were offered. FOMC is pretty much just there, but understanding why this was the low, if anything. Mm, let's see. Damn, I chose a bad day to do this. I was barely at my charts. Okay, let's see real quick. Let me see if ES did something better at that time. Maybe we can justify like that. Oh, there we go. I got something. Um, look at ES. Look at ES's chart real quick. Especially for that FOMC wick on the 1 minute. You notice. Where's 9:30 open? 9:30 open, we ran up just like the way we did on Nasdaq. We pulled back down into the balanced price range. Do you notice how ES, by the way, did not was not as diabolical as NQ? Like its retracement was not that aggressive. But if you note out the fair value gaps that are left behind on this little run up, right, that haven't been gotten mitigated yet, before FOMC even came out, we pretty much took out 5686. 25 right there. So this is the low that was available before FOMC statement came out. This is the only fair value gap that's available to make us hold. The only reason why I'm looking at the market like this is because this we don't know like which way it's going to go yet, right? So we're still assuming that it can go either direction. But for somebody who has a bullish bias after the market, I mean the break of structures and and the push ups have already happened, we want to make sure that all the fair value gaps that are being left behind are still being respected. So the fact that ES still continued respecting this gap, because if you notice the bottom wick of it, it's practically the rest of that fair value that hadn't been gotten filled. And then from there on is just bunch of 2022 models that continue to go higher. I mentioned this last night, and I believe everybody should make this a religion. Do not chase after external liquidity has been drawn unless it's news induced, like the way it was today, and we have higher targets. So yeah, I keep losing my chain of thoughts. Sorry. Fair value gap retest, break of structure higher. Fair value gap retest over here, break of structure higher. Fair value gap retest mixed in with the volume imbalance and IOFED, because when we have a breakaway gap that wants to get respected, you do not want to see it come down more than 2 ticks of the breakaway. Now, when I'll just add this to the mix just because it feels like I'm speeding through this and there's not much to talk about for today. But where do you want to see breakaway gaps coming in? You want to see breakaway gaps coming in when there's a breaker there and we have a dealing range that did a lot of back and forth. So the last gap, you don't really want to see it get tapped into. You can see the high, or I mean the high of that gap, but you don't want to see it get cut through. I'll be honest, if this got cut through a little bit more, I would have not trusted this anymore. But it did not get cut through, and that's exactly what we want to see. After that, more 2022 models runs up, consolidates a bit, and break of structure higher. This was our current low, I mean current high that came in. And a lot of times I mentioned this, like, look, when we get a delivery to external liquidity, how do you know if it's going to continue or if it's going to reverse on us? We want to see immediate rebalancings. We want to see a slow grind that's trying to either press into a higher time, just a normal fair value gap, or we want to see like an instant displacement right back down, saying that no, I'm good to reverse. Because if you look at it from this morning, right? I'm like I mentioned, I was doing this based off of time based and the fact that the Nasdaq's 15-minute fair value was there. This one right here, buy side liquidity, fair value gap right here. Do you notice? You could notice that we didn't actually fill in that gap entirely, so it made sense why we had a little reaction over here to giving us a pullback. So we want to see displacement coming immediately down like the way it did over here. But now when you compare this situation to over here, do you notice how we only run up and we're doing a very, very slow grind down back down? It's not coming off with displacement. It's not showing willingness to continue going lower. And how can you tell if it's showing willingness to continue going lower or if it's going to respect the gaps? Do you notice how on this side we have bunch of bodies, barely any wicks? It's full on bodies showing that it's kind of heavy. Whereas over here, it's still coming off with wicks, telling you that okay, it's not really that heavy. It's gonna try to fling back up any moment, whether it's an inducement or just to actually show that it wants to continue flipping back up. We did the run up. You can see that a lot of this run up was a rebalanced run up because once we got into this area, we start zigzagging it in. As soon as it does the break of like a continuation higher, it immediately fills out the gap. Continuation higher, it fills out the gap right here, and then we finally start doing breakaways, spooling into the weekly high. Again, we need to be open minded to these liquidity points. The weekly highs are always, whether we're going to get a full-on reversal or a retracement, you need to understand why we are doing certain things from these areas. After the weekly high got taken out, that is where a bunch of people's stop losses are sitting. That's where the most amount of people are FOMOing into longs. So how does the algo do it? As soon as the candles cut through the weekly highs, we instantly displace down. What do we do after we displace down? We leave behind this little small fair value gap, which is creating us. It's this is not the ideal 2022 model, by the way. Okay, because I don't think ICT teaches like this, but this is how I take my turtle soup entries. After we get a displacement of right back under, leaving a fair value, you'll notice most times, like do you notice how on this pullback over here, right? There's no bearish fair values that got created. On this little pullback that happened over here, there's no bearish fair value gap that got created. So the fact that a bearish fair value gap got created over the weekly highs, which is probably one of the most important liquidity points for us just for the day or just overall, because we've been again pressing lower. We want to make sure that we don't get caught up with this. So after we started pulling right back under previous weekly highs, it offered us one entry for a fair value gap, and then from there it just starts pulling back. how how do we know where it's going to pull back to? after a liquidity or external liquidity has been delivered, you want to take your handy dandy Fibonacci tool and figure out where equilibrium is of the dealing range. So for me, I take it one trend at a time. I usually just try to keep it like this, which is very allowed. But at the time, we don't really know if it's going to come back all the way down here. So what I do is I use the most relevant swing high. That's part of the entire trend itself. As you can see, it's this one. Why am I not using this one or this one? Because this one is part of a consolidation slash retracement, whereas these were just rebalancing fair values that were happening off of expansion candles. So after this fair value gets retested, it just starts pressing down lower, right? Pretty clean move back down. No fuckery, no bullshit in between. They're leaving behind these breakaway gaps. Every single person who's pretty much comfortable in these longs, they're all getting taken out. They're all getting very uncomfortable. Now, this is where you start adding a little precision to it. Do you guys see any fair value gaps that have not been mitigated under equilibrium? This is the only one. Why am I not using this fair value gap, which is hovering at equilibrium? Because it's already got mitigated. I'm not interested in that on a gap that's got mitigated because again, I just like I started this stream, the market is, especially when it comes to fair values, it's like Tetris. You want to fill in the areas that have not been filled. So after getting this rejection over here, the ideal spot where it could have pulled back to was equilibrium. And if it continues displacing into equilibrium, is going to try to tag into the closest fair value. What happens after this fair value gets retested? We go for another move back up. This is officially a 2022. This fair value gap that happened right here, that's where your 2022 comes in. Why? Because the thing is, for 2022 to happen, we need a market shifter structure. We didn't get a market shifter structure over here. I'm just doing it based off of a turtle soup. But the market structure shift does come in after these swing lows get taken. Where are the swing lows off of this entire move up? Let's mark out right here. That's the intermediate swing low we have this one right here. So we have officially done a market shifter structure, and there has only been one fair value gap left in this entire spot. If you We have this one as well, right? And I'll tell you exactly why you should not use this one. We use our handy dandy Fibonacci tool again. We find where premium and discount is because the market loves premium and discount. You wanna make sure that you're always buying in premium and shorting it back into discount or vice versa. So how many fair values are actually above um equilibrium or equilibrium of this drop, like which one goes into premium? This is the only one. Whereas if you look at this one, this is not at equal, I mean, this is not in premium. So you don't want to end up taking this entry because we know how the IPDA functions. It goes from premium to discount. That's practically what we have been doing all day today. So this was a very good 2022 model where it swept out weekly highs. It comes back down, forcing the market shifter structure, taking out all of these swings. One, two, three. It doesn't matter which one. And then after that, there's only one fair value gap available. It's not even a question about like, oh, which fair value to choose. It's the only one available. So that's the only logical spot where you could have tried to attempt a short. And like Luke said, he was looking for 936, which it did deliver on Nasdaq. By the way, Nasdaq was a little bit better, and I was just showing you ES, but let me just do that real quick on Nasdaq as well. You'll notice only fair value gap above premium. We mark out this one right here, and that's your entry. Where do we take profits? Take profits at the lowest low or the lowest body low. A lot of times I like it when they start stacking these wicks like this, but in this case they didn't really do relative equal lows. There was a relative equal low like right here if you turtle souped your entry. But other than that, like in terms of taking this entry, there's no relative equal low that's left behind over here. So you would have just had to do it based off of bodies, or you should, or just do it based off of um the wick. Yeah. But in terms of today, like FOMC was definitely a little like I'm not gonna say it cooked or anything because it did deliver to previous day high. The fact that all last night, I mean all yesterday, we had accumulated and we have been avoiding previous day low over here. You can tell, like we ran up, we came down. Let me blow your minds real quick. You want to know why London low was the London low? Remember the order block that I mentioned this morning? Damn, I just messed up something. I'll have to fix that later. Remember the order block that I mentioned this morning? I mean earlier when I started the stream. Oh, the low of yesterday's move was the halfway of the order block. And did I mess that up? What's halfway of that wick? Oh, we did not tap into it. That sucks. Okay, so there was no way to actually justify why London low was the low. It's fine because the balanced price range was here. There's a wickless candle over here as well, so it does make sense why I stopped over there. But we were not trading London anyway, so it's fine. This morning we pulled back to new day opening gap, and then we just started running up. Now, look, today I would just say that it was simply if you had the right bias, which was bullish before Asia highs, not Asia highs. The 15-minute swing high at 929s got taken out. Bullish bias was available. After that, though, you had to be open-minded for a possible market maker X model because that's the correlation between the fair values from the higher time frame to the lower time frames. I will write this out real quick just because I know somebody's going to want to ask later. 15-minute, 1 minute market maker X. What's next? 1 hour, 5 minute market maker X model, 4 hour, 15-minute market maker X model, daily, 30-minute market maker X model. So the way that I try to keep it some as simple as this because market was not in a rush to really go anywhere this morning. It wasn't gonna just take out previous day low and right before FOMC. So when we're now moving with news inducements, you can always expect a reaction from these higher time frame gaps to do something like these nested market maker X models. Nested meaning that they're only going down to fulfill targets, whether it's a fair value gap or whether it's just a quick rate and sell side liquidity. But it's not going, it doesn't have to stick because again, we're just playing the reactions. We're just expecting a reaction and we want to get out before the reaction is done. That is exactly why once this 15-minute gap got tapped into, we pulled back. I can't justify why that low was the low. This was just simply a turtle soup. Like we had relative equal lows over here, came down, just started 2022ing it, just continuing it back up. What else did I miss? Okay, I'm gonna need you guys to start shooting me questions because, yeah, in case if I missed anything, because I don't have more to say. No questions?
No, I
Great,
think that was
great
clean,
stuff.
man.
Very clean.
Listen, ask me the questions because this like I don't trade the Ori model. I don't trade like PM Ori models, things like that. For me, the market is a big ass game of Tetris, okay? So wherever I see inefficiencies that are lining up with sell side liquidities, that is what I'm always targeting. I do that all the time. There is a chance that sometimes it might not work out, but most of the times, like maybe 70% times it'll work out. So for me, it's just based off of reactions and where the gaps are getting left behind. I don't know if you guys noticed, a lot of the times this week when we would hop into shorts, you would see that full rebalance. Why are they doing that rebalance? Because the body that gave us that big red candle, it's a big inefficiency. So they need to order pair back up there so it can continue back with its trend, with its order flow. So have even doing a drop like this, it's fine. It's not a big deal. Like it shouldn't try to change the order flow because all this pretty much just was just a reaction from the SMT. It was just doing a retracement after that. I'm pretty sure if I try to dig in a little bit higher, I can justify why that 144 was the high. It's the rejection block. Yeah. So and on top of that, it's still staying stuck inside this 4 hour SIBI. So you see 4 hour CB was the high, and remember how I was talking about we need to expect market maker X model reactions. The 4 hour BISI, I mean the CB gave us a quick 15-minute retracement. 15-minute, I know it's not 15-minute like oh it's gonna take 15 minutes, but it's gonna go for 15-minute levels, and we pretty much just knocked out all of these green candles. When you start seeing these big ass green candles coming in back to back to back, and we start cutting through them, you best believe they're gonna get rebalanced because the market is always gonna try to fill up inefficiencies. If it's not filling up inefficiencies, it's going for somebody's stop. So as long as you're aware of what has happened on the left side before you're trading, you will pretty much have an idea, are we going to an inefficiency or are we going to a liquidity point? So after the 4 hour SIBI got tapped into, we pretty much just go for a retracement, take out stop losses, internal stops. Quick setup over here, 2022 model. On moves like this, because this entirety of the move was very big, I usually I used to be an Elliott wave trader before, so it's like for me, after a high gets put in, I'm always looking for a ABC. So a lot of times, like after this drop gets put in, right? Yeah, maybe I would scalp it back up over here, but at most times I will be sitting sidelines to wait for something like this to happen so I can short it back down. This is a very clean 2022 model, even on Nasdaq, because Nasdaq came above previous day high, it displaced right back down, leaving behind fair value gaps that you can short right back down into. If you line up liquidity points with macro times, it kind of becomes slightly easier because even if you notice this high, which I'm actually just noticing right now, this high gets put in at 310. What is 310? The end of a macro. So if major liquidity points are being taken out on during a macro time, and it's again taking out a significant sell side liquidity, that's where you want to practice your 2022 models and 2023. Because even though, like I mentioned, that this entire move up is a bunch of 2022s, if you want the bigger moves to happen, that's how you pretty much look for it. You want to wait for these previous day highs, previous day lows, or bigger time frame liquidity pools to get taken out, and then we look for our fair values that are being left behind. Those fair values is where we take entries on, leaving a stop loss at the swing high, and then as soon as we get the displacement or continuation from our entry, we start bringing our stop loss and trailing it down, putting it at break even. When do you move your stop to break even? As soon as you get a displacement lower. So as soon as this happened right here, um respects the gap, it does a lower low. Once that lower low comes in, you move your stop to break even, because if you're taking entries over here, there's a good chance that this entry should not be seen again, and if it is, we're wrong. We are wrong. You keep it very simple. You don't overthink like, oh, it's going to try to do one more liquidity sweep. No, because the a lot of times around these liquidity pool areas, it's all manipulation. And how can you tell if it's manipulation or distribution? Manipulation numbers will not want to get sit in for too long. They're not going to want to play around in those areas for too long. They're not going to give people a chance to get out of their FOMO entries, inducements, whatever crap that they got sucked into. So after this low gets taken out, feel free to move stop losses to where you need them to be. Same thing over here. When I took this short, right, as soon as I got this second low to get broken into after retesting the 5 minute gap. And why did I wait for this low to get taken? Because I needed this low to get dropped for me to count it as a market shift of structure. Like I know that over here we do a pullback, and it's inside the fair values, but at this time I'm not confident if the fair value is going to hold or not. So I still took it with the stop over here, but we can't move our stop losses to break even until the displacement has been taken out. So you notice if I take an entry all the way over here on the 5 minute fair value that was offered at lunch, this one right here real quick, just so everybody sees. If you after it gets tapped into it and it comes down, notice it doesn't come back to our break even stops. It shouldn't, because if that entry or this reversal is real, the first leg will always be like, it'll be perfect. Let's put it that way. Like it will never do a back and forth. The only time where it starts getting messy is around the third leg, or yeah, it's actually always just the third leg. But the first leg will never be messy. So never question the entries, put the stop losses, and pull them down to break even as soon as you get displacement lower from the previous swing low, and then it should not be seen again. And only time it's ever seen again is if we're in like a tight 12 point, 30 point range, like how Asia gets stuck in sometimes. But it should be, when you take these entries, when you take these models, things like that, you need to keep it as simple as possible. Whereas, like, you take entries on fair value gaps, or you take entries on inversions, rejection blocks, whatever the case may be, but you put a stop at the swing low or the swing high, and then you let the price unfold and tell you if you're right or not. Mm, what else? Could you explain balanced price ranges and when you catch Um, so balanced price range is not really something to anticipate. They come up at relative at significant levels, but I usually try my best not to get stuck in balanced price ranges. Like even this morning, I was kind of upset that I got stuck into Sorry about that. This morning when I took the longs over here, I was playing it off the 30-second fair value, which is right here. And why did I take this entry? Because we're setting up relative equal lows. So if you notice right here, we had a bunch of relative equal lows sitting over here. We purged out the stop. After the stop got put in, this failed to do a swing high. Like, it failed to do a swing high. We didn't take out this wick. But on this second internal rate, we finally took out the wick, giving us a 2022 model. Um, I try my best not to get sucked into balanced price ranges because, dude, you want to pull your hair out. It's some chop. You're not going to be able to hold your biases. The only way to play balanced price range is to recognize that it's happened and you want to see a low liquidity run back into them, meaning back into the low of the balanced price range, coming back into the lowest point over here. And then in Asian session, since we still had to deal with, we can't just ignore that it boxed up for this long. They're not just going to let Asia people sit through their longs. So we need to assume that it's because there's a balanced price range over here. Notice that even in London, it only comes down to the bottom swing. It doesn't actually go down for the lowest low, but only the starting point of the move back up. That's what needs to get taken out for balanced price range, not the entirety. It doesn't have to do a massive drop like the way NQ did. NQ is actually very dirty for this because when you look at ES on the other hand, ES did it the way that I would really like to play balanced price range. We got a balanced price range right here, small little box, a little calculation right before they break it up, and then look at how we drop through. It's low resistance. There's not much back and forth into it. It just immediately comes down, takes out the swing lows, and that's it. Balanced price range is done, and then we reassess it. It's not something you want to constantly be trading, but there are circumstances that we get stuck in balanced price ranges. So my only recommendation is, like, if you feel like we're chopping around in price, avoid it. Get out of your positions as closest to break even as you can and wait for something like this to happen where it runs up away from the balanced price range, and then look for signals where it's going to end up coming back into the balanced price range as a low resistance. Why do we want it to be low resistance? Because it makes us quick money. It's not going to take us 38 minutes for like 40 points like the way I waited in Asia this morning. Because I mean, not Asia, in today's pre-market, it's gonna be quick. It's gonna be is it's just supposed to be an internal sell rate. Like that's it. Like it's a way to represent that anybody who chased the run up after the consolidation, the algorithm wants to make sure that they all get stopped out. It happens very frequently, and it'll happen a lot more too because it's repetitive. I've noticed this happen a lot of times. So, Cook, you're the one who asked that. So you let me know if that answered your question. Oh, he ain't even here. Okay. What else did I miss? In terms of no, that's really it. For me, look, you want to start off with the highest time frames, which is the weekly, but right now, since we're pretty much doing an inside range this entire week, there's no reason to really look at the weekly. Um, but everything else, like, get your levels from the daily. Notice this, right? I'll point this one thing out for you too. This is the low of the daily candle so far. And if you notice on the daily, this is the bearish order block. And as you can see that we cut through that order block, right? But remember what I told you about correlations of PD arrays and higher timeframes, the market maker X models, correct? Notice this real quick. Where's our first high this morning? 901s, right? Yeah, 900 is a nice big figure number, whatever, right? But it comes back immediately into the bearish order block. It just runs right into it. What happens after the daily order? What happens after the bearish order block gets hit? We do a nested market maker sell model. The reason why I'm using the word nested is because the algorithm wasn't done. It's just a way to keep things volatile. It's a way to pull us back without actually changing the trend. So they use this bearish order block as a way to just pull us back down and retest the remaining fair values that were left behind. Just a quick thing, why trust this fair value over this one? Same idea, premium discount. This one is closer to discount, whereas this one is very deep in premium. So using the idea of premium and discount all the time, it helps guide you into which fair values to use. It's okay if it comes down a little bit more, but you want to make sure you're getting closest into premium, into the discount area, because you don't want to end up buying in on this fair value, and then you got to sit through all this drawdown. There's no point of that. So a lot of times when these fair value gaps are getting retested and things like that, you see the reaction we have. They're not going to manipulate too much lower than where they need to. So this is discount right here. Everything under the 50%, we pretty much come into these inefficiencies right here. And you see it, right? Like they don't play around there for too long. That's what we want to see. We want to see it instantly trying to get away from these manipulation areas, especially since they did a run up first and then we pulled back down. We don't want to see it playing around over here. Same concept over here as well. Premium discount. Why not trust this gap or the high of this gap and trust it lower? Premium discount, because this is the remaining of the fair value that's under discount. Crazy how it works, right? When we're doing retracements, this is how you tell where price is going. I'm sorry, I'm dying on the inside. But this is pretty much, if you have a bunch of gaps that are coming up like this, where you don't know which gap to trust. Sometimes we play around over here, sometimes we play around over here. You need to understand, is the IPDA consolidating? If it's consolidating, it's going to hold on to this gap. All they're going to do is they're going to do a box, do a little back and forth inside over here. But it's in this case, it's not. And then this is the only gap into under premium. I mentioned this earlier. The algorithm will give you signs of how it wants to move. So because of the fact that this first move itself, right here, um, the first move pulled back under discount, you can assume that for the remaining of the day, it's gonna constantly keep moving like that. It's a pretty safe assumption, by the way. Okay, but that just helps choose just better fair value gaps. You can also run OTE, but as you can tell, OTE is probably not gonna get hit in this move. But I stick with premium and discount, and if I end up going into a little bit drawdown, it's fine. It's not a big deal. Um, but No, I think that's pretty much it. Because look, this entirety of the move up, I can do premium discount on every single one of these swing sides, and you'll notice that like each one of the fair value gaps will most likely line up with where premium and discount is. Damn, yeah, I'm about to make my charts look real ugly by the end of the day, man. Do you notice the pattern? Do you notice the visual? It's it's yeah, but cool trick, right? Any questions? Oh my god, first person typing their question. Apparently, you guys are all pros. You guys don't even need me to do these reviews. Is this? I think Luke's gonna post it. No, but look, seriously, ask me questions because what is it that you're trying to digest? Oh, by the way, you can unmute yourself. I don't really care. You guys can all talk.
No, it's actually not. I'm thinking about what you're talking about, where you go into the day, you're looking at uh, day high, pre low, trying to figure out which way it's going to go to, and then finding the right fair value gaps. Time, time is the most important. All that. I'm still like dodging. I'm more of an ORI. See the overall picture. Sometimes I'll miss the ORI or
No,
not pick the right ORI.
even if you're trading ORI, right? That's completely fine. But you should still be able to use premium discount as a target after you take your ORI entries, because not every time do we actually go into liquidity. Last Friday we missed the wick. Yesterday we missed the lower low on Nasdaq while ES took it out and it did the S&P.
Right.
So when you have equilibrium, you know what you want to look for around those areas. Because if you look at because if the trend is still intact, it's not gonna try to stay under discount for too long. That's the manipulation. But now, whereas over here, if you see candles continuing to stay heavy under equilibrium, you know that it can signify deeper retracements. So even if you take a ORI entry, if you apply a 50% on the, I mean, yeah, 50% on the swing, which you took your ORI entry, you know where to expect it to mess around with you, where it should start getting heavy for you, things like that. So a lot of times, like, when I'm in these trades and we're getting close to equilibrium, like, look, I was in these shorts right here, right? I was real comfortable holding on to the shorts as we came into equilibrium of this entire trend. But the fact that it decided not to be heavy where it should have been, like, as soon as 862.75 gets cut through, I wanted to stay a little heavy and create a bearish fair value gap that's closest to equilibrium. But in this case, it didn't, which made me kind of get out of my trade. Like I actually ended up getting out right here at 860s. You but if you have this on your chart, you know that, okay, like, after it touches equilibrium or after it taps into discount, it might give you a small inducement candle that's going to mess around with your bias a little bit. And you might still end up being right about your draw, but you want to make sure that you know the pathway it's going to go to, because if you can't understand the pathway of how it can move, it's very easy for you to get stopped out or panic out.
Yeah, or yeah, yeah,
That's exactly why I leave previous day high and previous day low along
yeah.
with
Start sweating.
equilibrium available, because look, if my bias is bullish, right, and I'm looking for higher prices, I want to be taking entry as close as I can to previous day equilibrium. I don't want to be, I don't want to end up chasing the high. Let me just do, this was the swing low yesterday. This was
I like I like explaining the balance price where you don't want to enter in consolidation. Trying to
unfor
distinguish.
Okay, so unfortunately, I'm still working with balanced price ranges and trying to figure out how to
Go ahead.
expect the accumulations before they happen. But I will be completely honest with you, I cannot, like, I don't think there's been that many videos posted by ICT explaining how to assume that we're going into consolidation or how we're going to, like, be expanding that day. So in terms of balanced price range, it's very hard for you to predict that's going to happen until you end up getting stuck in it. My only advice, if you ever feel like you're getting stuck in balanced price ranges, try to take your position off closest to break even. And if that's not the case, then you just hope that your draw of liquidity is right one more time before it ends up fading. Because if you take a look at Asia yesterday and you take a look at New York AM this morning, like, I'm talking like the first few minutes, you can see how they immediately go for their draws and then they fling right back down to the balanced price range, like the low of the balanced price range. So, trying to figure out where it's going to happen and why it's going to happen, it's very difficult. The only time where I can justify a why is, let's say, if we had a really large expansion in London or Asia, right? Then I know that, okay, maybe New York AM is going to do a balanced price range.
Yeah,
We might get stuck in an accumulation. But then, you know how a lot of times we get, like, let's say we've been dropping all London, right? And now we get stuck in a balanced price range, and we're missing a lot of buy side liquidity delivery. So we're gonna try to take entries on that chop, thinking it's finally gonna break out, but realistically it's most likely not, and it's just gonna keep sweeping out liquidity over and over again. So the best way I have found myself to play balanced price range is let the liquidity get swept, avoid it as much as I can, and then once that liquidity is done and it shows sign of a 2022 model, 2022 meaning, like, it took out the swing high, we get the market shifter structure and it starts displacing downwards,
yeah,
they'll leave fair value gaps for you, right? Once those fair value gaps are left behind, you have a target. So the way I'm showing you how to use or trade balanced price range is I'm telling you, like, where you can expect targets to be and how they're going to get approached into. Because when we're after the balanced price range draw, like, or the manipulation of part of it has already been taken care of, the opposing liquidity will most likely be low resistance liquidity. So meaning, like, it's quick money, it's good money, it's easy money. Because it's not that you can't make money on high resistance. You really could, but if the range of the high resistance is not like, if it's not large, then there's no point of playing 30 points back and forth over and over again. Whereas, like, you can just wait for it to take out the draw and then you can flip it back down. But
and then stay.
yeah, there's no legitimate way to actually like figure out why the balanced price ranges are happening. I have not actually, even in my experience, like I try to like note out the days where we did balanced price range or accumulations, and I still have not been able to figure out. Like I came up with something called the box theory a few years like a year ago, where like if we ever get stuck in in a balanced price range, right, I'll actually just try to scalp it back and forth. Like it'll keep a relative it'll be like support and resistance, like like retail mindset type of thing. Like
Yeah.
it won't fling too much outside the box and it won't fling too much above the box, because now if you look at this yesterday's action, right, yeah, we had a bunch of wicks, but if you line up the bodies are the same. Like they're literally the same. Like they go to the same number, same low, same high. And we had this wick that popped out a little bit, and then we had this wick that popped out a little bit. But that's the only way I've found ways to play a balanced price range myself. I'll talk to Sal and see if he has any videos that go breaking down, or maybe I can use it for my own knowledge. But no, balanced price ranges are probably one of the worst. Like, ICT just recommends us not to trade those types of circumstances anyways. We're not like, we want to be trading easy markets, because more we try to force action in this type of circumstance, then when moves like this happen, we're not going to believe them, because you're always going to be in the mindset, oh, as soon as it takes out the high, I got to flip it back down. As soon as it takes out the low, I got to flip it back down. Whereas when you look at it today, there was no flipping it back down. You just had to
Mm-mm.
know where sell sides were, and you had to be open minded that was going to expand higher. So it's you don't want to end up creating like bad habits because you're trying to learn trading a balanced price range, because that's exactly what I told myself after I came up with the box three. I was like, you know what, let me just avoid it. Like unless if I got some eval or a combine that I got to do, you'll not. I will try my absolute best to stay away from this type of action.
Yeah. Yeah.
Um,
I'm losing my hair because of that.
say that. Say that again.
My my hair because solid.
You keep cutting off just a little bit.
I don't. I don't know. Sucks. I just said I keep losing my damn hair when I get stuck in consolidation.
Yeah, if you the only times you will get stuck in consolidation is if you're taking entries in deep premium, because now let's say that we do have these rare days where the market does nothing besides up and up, or down and down, right? So when we get these balanced price ranges, the only reason why you're stuck in is because either the market's not offering a better entry, or you're not waiting for it to come back into discount. Because even if you just allow the balanced price range to come into discount before going into your draw, or premium before it goes to your draw, then you will be able to just navigate it a little bit better.
Yeah.
Look, let me
I'm my
look at this, man. Like, look, Asia highs was an easy ass target, right? Like after doing this nasty ass drop, them popping it all the way up here, there was no way in hell that this morning they were gonna leave Asia highs. Absolutely no way, right? But now look what I end up getting stuck in: a balanced price range. You get what I'm saying?
yeah.
They do these balanced price ranges because they don't want to pull the price back down before doing the delivery. So the most they will do is internal. So a lot of times when I to be able to identify a balanced price range, if there's a lot of relative equal lows that are being stacked, like I said this morning when I came to the market, I was just waiting to see if these relative equal lows would get taken out, and you can see that it gets taken out right here, but this swing low fails to do a break of structure higher. Whereas this lower low, it does do the break of structure higher, because we get a market structure shift right here. And then after that, what happens? We come back and do a 2022 model. And only reason why I trusted this and I did play it into it is because Asia highs was still left. And you notice we play around in the fair value gap, doing another balanced price range. And how high do we go? We go high enough to take out Asia highs, a little bit higher to do the inducement, letting people think we're about to break out. And then what happens immediately after? It dumps right back down. So it's like,
Mm,
you're never gonna actually know, like, if you're getting stuck in a balanced price range, bro. I really thought I was about to get my move up. Like as soon as I got in over here, I thought I was about to get my move up, but nah, bro. They had other plans. But as long as you're following all of your other rules, like, again, I played this like a 2022 model. We had relative equal lows right here. We did a break of structure, and I made sure that I was getting in after the break of structure is happening. because like there's no point of me buying in like somewhere on this fair value gap while there's already equal lows being stacked over here. Because I know that at some
Yeah.
point, whether I'm right or not, there's a chance it can pull back over here. So there's no point of me taking that excessive risk for no reason. So this one was just slightly better, but you can see, man, I still ended up getting stuck in chop. Like I know how to play the balanced price range if I'm not in the balance, like if I'm not stuck in it. But in terms of identifying it, even clearly, I suck at it.
Yeah.
The only thing I can really recommend you is like, look, if you ever have questions about anything or you feel like you're not that you need more education or more knowledge about something, dude, when you see it on your chart, take a picture of it. Know what happened on the left side and then know what happened on the right side. Only reason why I trusted this I trusted buying in on this fair value gap is because they after doing all of this, it's a market maker X model. Like it's a market maker buy model. Okay, we got the sell curve here, we got the buy curve here. So I knew that even if they wanted to drop it back down, they were not going to drop it back down until they did a massive green candle into these highs, because they need to fulfill the market maker, the buy side of the market maker X model before they actually do a Judas back down. So even like let's say if I wasn't in longs over here, then maybe I would have shorted somewhere up here, trying to target back into premium discount or just into the last few fair value gaps that were left. Maybe this low over here or this fair value gap right here. But it's as long as the draw that you're going for is worth the risk, it's okay if you hold the balanced price range. But now if it's not worth the risk, then like you're going to end up seeing boxes, right, where they're only 30-point accumulations and the draw of liquidity is only 12 points above the 30-point accumulation. Is it really worth you getting stuck in a 30-point back and forth for a 12-point higher move? Probably not.
Absolutely.
Yeah, so it's the same thing over here. Like, I played this to risk it for almost 50 points, but honestly, I'll keep it a buck. It was not worth the back and forth for me. It really wasn't. Like, if today was an FOMC, I wouldn't even have been part of this trade. But like I mentioned, like I usually don't trade FOMC days at all. Like, even after the news comes out, I don't trade them because it's like some FOMCs go really well, but then some don't go really well. And having that expectation of that, oh, every FOMC is going to do something, it ends up putting bad habits, especially when you're finally wrong. So I completely
I don't
avoid
know.
these days.
No, a lot of people. I should have did. Should have avoided last. I lost like funded accounts.
Dude, same exact boat, man. I had like 4,200 on 3 Apex accounts. I ended up blowing all of it on a FOMC in 2023. After that day, I was like, nah, I'm good, man. The most I'll do is evals on days like this, but nah, it's because now look, if you look tomorrow, it's gonna be clean as shit. It's gonna be so freaking clean. Like, you're gonna be able to recognize your model coming in, no messery, like no expectations, nothing. Um, who muted Cardi and can somebody unmute him? Yeah, Cardi, I don't have that privilege to unmute you, so you might just have to listen to my beautiful voice and enjoy it for now. But listen, ask me questions if you need to. That's really it. Because in terms of like why everything happened, why the fair values were the fair values were market price back into, it was just a repetition of premium and discount all single day, and everything else was just a back and forth, trying to fill up whichever inefficiencies were left behind. Luke, can you unmute Cardi? Oh yeah, there you go, Cardi.
Yeah, I did. I did.
Okay, look, I don't mind doing these reviews. I usually like do my own PDF files for the end of the day, the exact same way that I broke it down to you guys. Like, I start off on the daily, I go on every time frame lower and mark out every single inefficiencies lower. But I would really like it if you guys can just give suggestions on how you want us to approach this, because I'm sure I'm not the only one thinking it. Luke's probably thinking it as well. Silent's probably also thinking as well. So if you guys tell us that you only want to focus on where you should take entries and why you should take entries, then that's all we're gonna review. But me personally, like when I do my own personal daily reviews for myself, I try to justify every single swing high and every single swing low, which you guys might not be interested in because not everybody has that time availability to play every single high or low, which you should not be doing. You catch your one trade, please walk away. But
Yeah.
But you can do everything, and we can take the video on YouTube, mark up everything with the tool on YouTube, and to each their own. They can watch whatever section they like, you know?
Yep. No, that's true.
I think that's a good way to go about it because then you cover all bases for everyone, and that's what the chapter tool is for, you know. And most people don't really
Exactly.
utilize it, so when you start doing that, you make your content stand out and above everyone else's too.
There you go, SharkGB. Make those fair values weak. Yeah.
Dude, I'm so fortunate to escape with my account today. I was being bad trader.
Bad,
Being naughty.
Yeah,
bad,
naughty
bad
trader.
trader.
Yeah. I had
Let, let
to
me
force myself.
let me ask you guys something, right? And this is for the people who are red today. If you guys do want to send me, Luke, or Silent your screenshots of executions, we will try to help break it down in which ways that you could have maybe done it better, because a lot of the admins here, they have years of experience under their belt, so we've seen this for a lot of time, like a long time now. So if you do have any concerns about your own executions and how you could have done them better, feel free to hit us up on our DMs, because dude, I'd be bored out of my mind after like 6 p.m. So, let me know.
Hell yeah, I appreciate that. Y'all
Yeah, that's a huge amount of
y'all
value.
Who just tagged me?
I have a question. Are we gonna
Yes.
gap up or are we gonna gap down?
We are going to run right back up to the new week opening gap from March 9th. Take my word on it. FOMC has a very nasty habit of where it runs up, it'll take out a draw of liquidity, and they'll instantly rebalance it the last half an hour, just so that way they can cook all the option holders, and then they'll probably continue right back up. But listen, I will make this clear too. If we're gonna go back up, it's gonna be very obvious. Okay, I promise you, it's gonna look like Asia from yesterday. So it shouldn't be too much back and forth. They're not going to make it too struggling for us. But in my opinion, I think we continue going up into the new week opening gap that we left behind.
is that
Don't
like
let
2
me
weeks
make
ago or
it
last?
March 9th. So it's this one right here. I'll point
The
it out on my chart.
367 to
Yeah,
411.
Yeah,
yeah, we
basically.
never.
Yep. So that is most likely going to get tagged into on the fact that, like I said, I noticed this a lot for FMC. Like, they'll never give options a good way to hold, man. They're because market's not going for hour stops only. It's also going for option traders. They wanna burn as much as data as they can, or burn as many as options as they can. So, but from now on, though, I really do highly recommend people trying to break down the time frames, like the way that me and Silent and everybody else does, because that way you always know why the levels did something. Because now when I correlate these higher time frame PD arrays to the market maker X model, a lot of the reactions that happen, they start making sense, don't they? Unless we're just in like news induced day and it just continues running up. But definitely definitely try to journal out the things that make sense, the things that don't make sense to you, because that's the only way you'll probably be able to figure all of this out. All right. Going last call for questions. Even though my DMs are always open for you guys, except Chad. We don't. I have Chad blocked. He's on my ban list.
He's
But
on
yeah,
your
no,
shit.
my
Rip.
huh? Yes. So if you guys have any questions about something that didn't make sense to you, just shoot me a message or whatever, and I'll happily just break it down for you personally. And things like that. But I know my perspective of the market is very different. Like, I try to keep it as it's Tetris. It's literally Tetris. We are filling in inefficiencies back and forth over and over again. And how you recognize that, you just start adding all these extra tools, like a premium discount, OTE, things like that, and everything just starts clicking for you. After a little experience with it, it'll start being a gut feeling, if anything. Because for me, everything's a gut feeling.
I like that. I never thought about it as Tetris.
Yeah, yeah.
Good analogy.
And it makes sense, right? Because like how the
Yeah.
candles are always trying to fill up the whatever's left behind.
No, no, no. Good.
Yeah, I like that, Mayhem. That's a good analogy.
He just came in here just to compliment a good analogy. Do you even know what I was talking about?
We're talking about the market being Tetris with all the inefficiencies.
Okay, so you did hear. Okay, okay.
Yes.
Oh no, oh no, you actually accused someone of something they didn't. Oh no.
How
Uh-oh.
dare you?
But again, that's none of my business, guys.
But yeah, no, guys, that's really it. I'm gonna Nah, there just wasn't much to really talk about today because the best movement happened from FOMC, and as I can say, like it's literally just bunch of fair values getting retapped into over and over again, and you should learn to trust these retests, like 50% fair value gaps, 25% fair value gaps. Trust that they happen because I actually do put limits over there, and if I don't put limits, I'll try to I actually count down on the bottom of my corner screen, like like the timer that's there. I'll wait the last 10 seconds right before the candle's about to close inside of a fair value gap and I'll buy it in type of thing. So, trust your limit orders, trust everything ICT is teaching and everything. It does work, especially on conditions where it does want to deliver somewhere. The only times where things won't work out for you is like, if it's not in a rush to really deliver somewhere. That's the only time things won't work out. But at that point, like, if it's not really trying to deliver somewhere, why are we trading it? So, but yeah. Or is it safe to say I'm good over here, or
Beautiful, bro. Beautiful. Go.
I'll try to